CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for December 28th, 2020. Please see our disclaimer for important information. In our last chart pack of the year, I'm going to avoid looking at the coronavirus charts that we have every week, and we'll resume those at the beginning of the year. Obviously, a lot of optimism surrounding the vaccine. But what I want to do, and this is kind of serve as kind of like a companion set of charts to some degree to the market letter that I'm writing for clients that will take the place at least this week and the prior week of the market minutes broadcast, which will resume at the beginning of next year. But I'm writing a quarterly letter, and these charts will kind of serve as a basis for kind of helping to understand some of that and what our opportunity sets are, what our challenges are, so on and so forth. But as we look at this chart from Gabe Cowell and Macrobond, it shows that Americans are sitting on a large amount of cash. We'll see that sentiment and consumer confidence is a little bit challenged right now. We do expect that to come back, but right now you can see that spending growth at the bottom is muted relative to pre-pandemic levels. Saving rates were high and they still remain elevated even though they're off their peaks. But deposits in currency, there's a lot of spending power for the consumer, which represents more than 2/3 of our economy. Consumer confidence, as I said, is a little bit challenged right now, and there's a huge gap. In fact, I just showed this chart here just a couple of weeks ago, and I've shown it a couple of times. This is from Piper Sandler, but it just shows you that really wide divergence that we have in the S&P 500 index and consumer confidence, which, as you can see, dating back to prior to the global financial crisis, had an extremely tight relationship. And so it's very odd to see this divergence here. And so, as I've said before, something's got to give. Either we're going to have a little bit of leveling out in the index, or we're going to have consumer confidence improving. And I think what we could see in 2021 is really a mix of both. This is a scatter plot from Yale and Market Desk Research, which kind of highlights what I've been saying kind of conceptually over these many weeks, that when you have a low interest rate, and on the bottom, the x-axis here, you can see the historical U.S. 10-year Treasury yield. When those rates are typically pretty low, you tend to have higher multiples in the equity market. And this is a reasonably decent relationship. You've got some noise around that 5% Treasury yield number, where you tend to have where you know, you've seen historically some very high multiples in the market. But generally speaking, you go 5% or less in Treasury yields, you tend to have higher equity multiples, and that's exactly where we are now. And that, as depicted in the kind of that yellowish dot there, that if you look at the case Shiller number, the cyclically adjusted PE multiple, or what they call the CAPE ratio, you can see that it's over 30 times right now, but we have extraordinarily low interest rates that are likely to stay low for quite some time. And so I just wanted to show you this to kind of highlight that relationship, that as long as we have low interest rates, that higher equity multiples are indeed supported. This shows you the relationship between commodities and the S&P 500, and you can see this time series, which goes back a long time. You can see some of these bubbles and how it's represented in this relationship between commodities and S&P 500. Now we are over 1.5 standard deviations away from the normal environment, and you can see that we've hit that in the late 1920s, the mid 1960s, even the mid 1990s, where we exceeded that 1.5 standard deviation level, which is statistically significant. And and this is basically the S&P 500 index level relative to the commodity index level. And so this is highly suggestive that, that we see kind of a mean reversion at some point. And that could coincide with a little bit of an equity market correction or perhaps better performance from the commodity basket. And I think, again, as we've said before, I think it could be a mix of both. This is a chart of basically the U.S. and the world. So this is a plot of the S&P 500 relative to the MSCI World Equity Index ex USA. So it takes the USA out of it. And you can see here that this is fairly stout in terms of the outperformance of the S&P to the international index. And so what this is suggesting is that you have some type of reversion where international equities do better. This is one of the themes discussed in my article, my outlook, that I do think international equities are going to be stronger in 2021. This chart is highly suggestive of that. In fact, this is from Oxford Economics. Again, this is one entity's opinion on things, but you have to go all the way over to the right-hand side to find the U.S. And there's two letter symbols for various countries, but you can see at the far right, the U.S. Expected return forecasts are fairly muted in terms of annualized returns. Now, this does not mean to say that the 2021 returns are not going to be good, because by and large the consensus estimate is for a perhaps an 8 to 10% increase, including dividends, in the S&P 500 next year, based on the continued recovery in the economy and the vaccine rollout, et cetera, et cetera. But over a longer period of time, it does look clearly here, at least by virtue of the Oxford Economics data, that international markets are going to be doing better in terms of annualized returns. Therefore, arguing that one increases the ratio of international equities to domestic equities in the portfolio. This is something else I talk about in the letter that will serve as the companion to this. It's this rotation into cyclical stocks. And you can see the green line with the advent of COVID. And again, we've seen cyclicals versus growth. We've seen that divergence take place over a multitude of years. And you can see that, never the twain, or rarely shall the twain meet, as they say. But in this case, we haven't had strength in a lot of these cyclicals, even though we've had this long cyclical expansion, this muted expansion. But I think what this really, really argues for is in 2021 that we see those cyclicals begin to show some strength. The industrials, energy, which is really taking it on the chin. We already see rig counts improving with stabilized and slightly higher crude prices. Financials should benefit from a steeper yield curve, and we're already seeing some steepening in that yield curve between 2 and 10-year Treasury yields. And this is not to say that growth is going to falter. It just means to suggest that cyclical performance relative to growth stocks should improve here in the coming year. Treasury cash balances. This is an interesting chart. Obviously, we know the story behind the story here. A lot of monetary stimulus, a lot of asset purchases. Now, this is the cash balance. So this isn't the Fed's total balance sheet, but this is the cash balance. And so the implications here are that when we do get this stimulus package approved, whether it's an override of the veto or whatever the case may be, and it's clear that some stimulus is going to happen, but assuming it's a $900 billion package or a $1 trillion package, you can see here that there's a lot of this money that's going to be spent off of the Fed's cash balance, and it's going to be injected in the economy, which is going to drive a demand for short-term fixed income investments, which, interestingly enough, could drive real interest rate yields further into the negative, which ironically would be really good for gold, and it'd be good for asset prices along the curve, including equities perhaps. But you see all that money hitting the market, driving the demand for short-term interest rates, could drive T-bill rates into the negative, depending on the texture of the final stimulus. But it will be interesting to watch the developments here. This is my comment on the yield curve, and we know it's already steepening. You can actually kind of see that right here in kind of a little bit of a macrocosm, if you will. This is from Scotiabank, but it goes back all the way to 1970, and this chart is really intended to drive home the point that once you start to get yield curve steepening, it tends to get legs, and it tends to persist for a while. You can see that yield curve steepening typically happens, it coincides with recessions, which is exactly what we're seeing here. It's going up, but it's just meant to illustrate the fact that typically you see much more steepening before you're done in the markets. And again, this is another chart that would tend to support, financials. Steeper yield curves are really good for financials, and this shows a kind of a general improving health in the economy when you have longer term yields that are rising up faster than short term yields. It tends to suggest that you're seeing more growth. It's obviously better for savers. It's not necessarily better for borrowers, but in a lot of cases, it's better overall for the economy. This is existing home sales inventory, and we know the housing market has been really, really strong. We see it in our own backyard. We know the housing stock is low. We need more homes, and that's certainly something that I face sitting on the city council here in my hometown of Cedar Park, Texas. The dilemma that we have is you don't have enough housing stock, and how do you create it efficiently? But as you can see here, that inventory on the market is very, very low, and it's just helping to support prices. And this is going to be one of the key themes, I guess, in 2021 is going to be, house price inflation, housing affordability, and availability of housing stock in some of these major growing urban areas. Consumer confidence. We've seen obviously a shot to confidence in the wake of the pandemic. We've seen that kind of jockey around a little bit, but it still remains somewhat subdued, clearly subdued relative to where we were before the pandemic. Consumer expectations were already kind of tempering a little bit, and they're at a little bit of a low spot right now. So again, this is the consumer. As we saw in the chart before, consumer confidence relative to the S&P 500 is hugely divergent right now, which is extremely odd. So, where do these indicators go from here? I'd like to think that consumer confidence will recover as we get a pandemic, and consumers will put their wallet behind their rhetoric, and I do believe that we're going to have a little bit better spending, but it could be a little noisy for a while, certainly until we pursue and achieve mass inoculations and herd immunity to the virus. Here's some data from the Conference Board regarding business conditions, and this is consumer confidence as it relates to business conditions, and you can see that is subdued, and we know why. We know that small business is struggling. It's been a very consistent theme that I've talked about in these charts of the week in my market minutes. You'll see some verbiage about this in my market letter, and I do think conditions will improve, but it's going to require more stimulus. And I think, beyond the 900 billion-ish package that's being discussed right now, I do think there's going to be follow-on stimulus, which will address some of these issues related to small business. But again, this number right here kind of reflects, these 1 to 10 employee type companies. Automobiles. We've seen some strength in durable goods, clearly across the board during the pandemic. And at times, automobile bills have been a participant in that. Right now, we're seeing a little bit of a trailing off in consumer confidence, consumer activity related to autos. Again, we know that consumers have a lot of money to spend. They're just not necessarily aggressively doing it right now in the auto sector. I do think that will pick up and look a little bit better in 2021. Vacation plans, not too surprising. With the surge in cases here in the last couple of months, we've clearly seen a trailing off in that. Obviously we've seen a pickup to some degree, even in the last 2 weeks in TSA checkpoint data, but it has to do a lot more with traveling to see family, not necessarily vacations per se. A little bit of a noisy chart here, but this is kind of capsulizing, I think, everything that we pretty much already know, that the 2020 losers, as you go into the category growth, clearly we've seen a drop off in movie theater activity, foreign travel over 90%, live entertainment, all of these things that we know have been curtailed: hotel, motel, aircraft, equipment, parking fees, taxi fees, so on and so forth. We've seen a huge drop in that area, but conversely, in this crazy economy that we're currently managing through, durable goods, vehicles, as I said before, at times have looked really, really good. Point to point, they're on the used side, they're up 23%. Boats and RVs, appliances, and probably not too surprising, liquor, and electronic games, streaming services have all benefited. That's where we are relative to a year ago. This is a chart that kind of highlights the global response to the pandemic, this global stimulus. We've had $30 trillion of global stimulus. You can see 10.5 trillion in the U.S. alone. We've, a little bit less than half of that is coming from fiscal stimulus, but we've had a tremendous amount of monetary stimulus. Looking at the U.S. And again, you can see this graphic here. It's equivalent to about 49% of GDP. Tremendous response. You've seen Eurozone, you've seen Japan, and you've seen a little bit in the UK. But again, the 28 to $30 trillion of stimulus that we've seen from central banks and governments accounts for about a third of global GDP, and tremendous response. As a result, balance sheets in developed economies are going higher. They're becoming more bloated. Lots of asset purchases. We see that basically that the balance sheets of developed market economies are basically where they were in World War II. They're above where they were in the global financial crisis, and they're even increasing in emerging economies as well. Now, the good news and the silver lining, although this is changing, and I do have a recommendation for the government, not that they'll listen to me, but while you've had this public debt as a percent of GDP go north of 130%, you see the debt cost of that, the cost of that incremental debt be very, very low. And the weighted average interest payment we know is fairly low, as we've been able to take advantage of some of these low interest rates for Treasury issuance. Now, the sum total of aggregate interest payments as a percent of GDP is a little bit around 2.8%, more or less. Now, the recommendation that I would have is, while interest rates are low, I really do believe that we should be issuing 50 and in some cases even 75 to 100-year bonds, because when we see this steepening cycle that we talked about earlier, we know that it typically plays out that way, and that interest rates are going up, that we should be locking in these low interest rates for a while, because this is the one thing that I know the Fed is thinking about. They're wanting to keep those interest rates low by virtue of increased asset purchases, because it does help to reduce the burden on the overall deficit from incremental debt service costs, interest costs, and those types of things. So that would be my recommendation. Not sure that there's an appetite for doing that right now, but it sure would help our fiscal imbalances. Comment here on unemployed. This is something that we know is out there. We know the unemployment rate is coming down slowly. That's very cyclical. You cannot not have that when you're kind of clawing yourself out of the situation we had earlier this year. However, again, tying back to maybe long-term unemployed, tying back to small business issues, that you have people that are on the rolls for longer, and some of these programs are literally right now expiring, and if they don't get refunded by fiscal stimulus, this chart here will become more of an issue for the economy as a whole, because you've got an increasing percent of those who are unemployed that have been unemployed for 27 weeks or longer. This is a chart that kind of brings together a little bit of two things. So you've got the unemployment rate in the gray, and as of September, again, this is looking at it from a quarterly standpoint, but you were at 7.9 on the unemployment rate. You had a personal savings rate of 15.8. We actually saw that in perhaps the first chart of this pack, which shows you that consumers have a lot of cash on the sidelines, but we still have a lot of unemployed. And you can see how this has trended over the quarters. At the end of last year, we had a very cyclically low unemployment rate, and we had roughly half the savings that we do now. And so you can see how, we peaked in June in savings rate. This is where everyone got all their stimulus payments, and a lot of people, particularly at the middle and upper income levels, basically just banked it and saved it. But you see that number is coming down. Incremental savings. Now this is cumulative excess savings as a percent of personal consumption expenditures of last year. And you can see that we're seeing more saving coming in the market. This is from the Commerce Department, as well as data that's crunched by Goldman Sachs. And you can see that incremental savings by the consumer, again, this dry powder that could go into consumption, it can go into durable goods consumption, it can go into asset purchases, and it certainly at some point, I believe, will go into inflation. You can't have this much excess liquidity, and you cannot have an infinite rise in savings rate. At some point, you reach an equilibrium point where it's just not practical that you're going to save more money. You're going to begin to roll that into the economy, and I think at some point this will crest and roll, and you'll begin to see more consumption, which will help us drive inflation and eventually get the Fed to its 2% inflation target. This shows you the deficit versus the dollar, something that we talk about a little bit in the market letter, but you can see the fiscal deficit here. Everyone understands that we're kind of basically blowing up the government's balance sheet to issue stimulus, fiscal stimulus into the economy. We know that more is coming. We know that there's probably a really strong appetite for an infrastructure bill in 2021. And with that comes this notion that you're apt to see further erosion in the U.S. dollar. And this, the darker line here is a real trade-weighted U.S. dollar against major currencies, and this relationship is reasonably positive. And if history proves prescient, then we should see further erosion in the dollar before we see it begin to strengthen again. And if we do, that will certainly help exports, it'll help commodities, it'll help gold, it'll help energy, it'll help a lot of different areas. This is the trade-weighted dollar from Haver Economics plotting this. And what it basically shows you is, or it doesn't show you, but it basically suggests that the dollar is not undervalued, even though we've seen, 5% erosion over the year. It just simply highlights that it's above that average, and we've seen peaks. I don't think we're certainly nowhere near a peak, but we're nowhere near a particular trough either, and that's why I think that dollar has further to drop from here. Now, China, I think this will be another one of those emerging themes next year because China is largely back to business. We're struggling with percent of capacity issues, and we're struggling with a lot of things. Obviously, we've talked about small business. Now, China, for its part, is kind of plotting ahead, and I think this is one of the themes as I was listening to the year in 2021 for the Economist magazine that you could really see some outperformance in Asia this coming year. And interestingly enough, despite the trade war, market share of global exports for China actually increased. And I think that's pretty profound because I don't think that there's going to be a large appetite to reverse course by the Biden administration. I think there's still this lingering bipartisan animosity towards China that won't go away. But I think what that says is that, China is going to continue to move forward regardless. And U.S. as a percent of exports is going to continue to rise too. But China's exports and perhaps the imbalances relative to the U.S. in China's favor are going to exacerbate. And another theme on China, which I think is going to become apparent here in the coming probably next several years, frankly, is an increase in internal consumption. And this chart is very emblematic of that. And I think what this means is that more of the consumption, there'll be less of a reliance on exports. Even though in that last chart we saw that percent of total foreign trade, which we know has been depressed, it's favoring China, but we know that internally China consumption is going up as well. As we conclude today, wanted to highlight something that is not necessarily going to be just a 2021 theme, but something that's going to play out over essentially the next decade. And this is the emergence of these millennials. And as people in my age group began to take the baton from the baby boomers who are largely entering their retirement years now, the millennials are now entering that phase along with that gap generation, if you will, and really beginning to spread their wings, prime household formation, expansion years. They're kind of just hitting their stride in terms of income generation. And so, what this says here is that, that a lot is going to depend in our economy on the ability for millennials to continue to drive that orange bar, that 35 to 44 year cohort higher. And drive that and drive the household formation up, drive the consumption up, the income, savings, investments, etc. And this will be a really, really important theme for the next several years to monitor. But I think we have great hope that we're seeing those trends even during a pandemic kind of take hold. So. Well, that will do it for the last chart pack of the year. Again, urge you to be on the lookout for the market letter and outlook, which will be coming here in the next week. Hope you have a wonderful new year. We look forward to resuming these charts of the week again next week and continue them throughout 2021. Be safe, and we will talk to you soon.